Welcome back for another top-notch video. This week, guys, we'll be talking about September 7th through September 11th. If you don't know, the top-notch channel is about TSP, Roth IRA brokerage accounts. We go over the stock market, see what it did for this week, do a very broad general overview, and then go into some technical analysis of where your fund should be, and then we show you where our allocations are. So if you're in those TSP funds, we go over the C, S, I, and F fund. If you're in the Roth brokerage IRA accounts, we go over the ETFs, which you can invest in, IVV, VXF, EFA, and AGG. What these equal is the S&P 500. These two equal each other, and then equals the S&P 500 is what we look at. The S fund or VXF is small caps. They equal each other. The I fund or EFA is international markets, and the F fund or AGG is bonds. And again, they equal each other. All these funds are very similar. We look at them. I use them interchangeably for themselves. So let's dig right into this week of what happened, what went on for the week of September. Very interesting week. If I pull it up here, check it out. Basically, for our funds, as you can see, we were down for the week for our top funds here. We're down for the CS and the C&S fund. Those are two big funds, basically S&P 500 and small caps. International markets were up just a little bit, and so is the F fund. For the year, the S fund pretty much, or the VXF, almost lost all of its gains for the year. If you actually look at top-notch gains, here we are for the year, guys. We are up 8.47%, doing very well. The top performing fund is only up 6.9%, and it happens to be bonds, AGG, or the F fund. All the other funds we are way outperforming. We are outperforming the C, S, I fund, and the F fund. We are on top, top-notch channel. We are on top, outperforming the market, doing very well. If you guys want to see that one more time, check it out. Please like, subscribe, or share to get our daily or our weekly commentary on our videos. We also post our moves on our Facebook page and Twitter account. Please follow us. The links are in the description below. Would really appreciate you have you guys along. Now that that's over, let's continue on our video. So basically, it was a rough week, guys. Funds were all over the place. A lot of volatility. Volatility really spiked. I have some really interesting charts for you guys to check out this week. So let's go through some of that stuff. The returns for the week are right here, guys, in the graph that represent. We started this week kind of losing steam here, and we thought we were going to come back here on the 9th. Made a good push here. In fact, the I fund got above here for a little bit and then went back under, dipped back under around the 10th, whereas the C&S never really recovered. And the C&S were down quite significantly. That's a pretty big pullback. So we'll have to wait and see where things go from there. Let's move into just a little bit of short-term market analysis and charts. Then we'll go into our charts and technical analysis, and then I'll show you where our allocation is. So the first thing I want to show you is this charts and analysis is from Jimmy V on TSP Talk. Has some really good charts here. I want to show you guys some interesting things. This is the S&P 500 or the C fund. As you can see, we really dipped down here in September. Keep in mind that the top-notch channel sold right around here, so we sold at a very good point for our funds. We moved them out of stock funds back to cash. And where are things going now? You can see this box he drew in here. One of the more interesting things I think he drew in here is he has this line here, which is at the top around the 320 mark, which is kind of interesting. That was kind of the last high we saw in June. Another really interesting thing that he points out is this 50-day moving average. Every time we've touched that, it seems like this summer, in June, we've been able to rise from that. We were kind of waiting for that last week, and we did hit that line. More on that on our technical analysis of what we're going to do now that we've hit this moving average. Where do you think it's going to go from here? Write your comments down below. Moving on to the S fund or VXF, where we see things. Much weaker chart here, guys. As you can see, his trend line that he drew in here, Jimmy V drew in here, not a good thing. We violated this 20-day moving average, which is not good, and we violated the 50-day moving average. The next line of support for this thing is the 200-day moving average way down here. So you want to be very cautious right now with VXF or the S fund. I would probably stem away from that just right now. This chart's a lot more supportive of the C fund. Moving on to EFA, where we sit. EFA is sitting above its 20-day moving average right now. Surprisingly, it did outperform the other funds. As you can see for the week, it was in the positive. So EFA or international markets, very interesting place to be with this. We'll look at on the technical charts to see if it's worth investing into just a little bit later on. Moving on to bonds. What do we see with bonds? The biggest thing we see with bonds is it's kind of got above its 50-day moving average, trying to get back above that 20-day moving average, and we do have an open gap up here. Usually open gaps tend to be filled from bonds, so just keep that in mind. And that now we'll move into a more broad, longer-term perspective. These charts are from CiovaccoCapital channel. Some very interesting things what he had to say this week in his weekly video. Please check it out. Very interesting. But overall, this is the S&P 500 from 2016 to 2020. Very interesting here. You see your RSI down here at the bottom. This is price here with moving averages and trend lines. So let's take a look at it. As you can see, some really interesting things here, guys. See this top trend line? This is drawn all the way from 2018. Tried to beat it here. Did not. Fell down quite significantly before we tried rising again. Didn't even get to the top here before we lost it here. And then in 2019/2020, guys, we hit that line again back in February. And when we hit again, it's quite significant downturn. Downturn, we hit the line here. Downturn, we hit the line here. Now we hit this line again, and it just fell below that. Is that a failed breakout, guys? And where do charts go from here? Saw a little downturn here, bigger downturn here, possibly bigger downturn here, or a possible failed breakdown, possibly. One really interesting thing that's kind of setting off some warning bells for me. Here are the moving averages, guys. Moving averages, and then we have our moving averages, and we have the this red line here. And on both cases for the moving averages, they're way above the longer term moving averages right here. When we fell here, which it didn't fall very far, and things were okay. But then again, when we hit this line up here, our moving average way above that red line there. We had quite a significant fall, huge comeback. This time we failed again, and the moving averages are just above the red line here. Could this be a failed breakout with our moving averages as well? Two warning signs right there. Keep that in mind. Our RSI is doing a little bit better. Usually RSI, when it's down here, charts tend to do better than when it's up here. It's overbought up here. But that is just a little alarming for me for the Top Notch channel on a long-term basis. So just keep that in mind. Here's another chart with basically open gaps. Guys, one thing we like to consider on this channel is the S&P 500 and all charts open gaps. So in the coming days, we did have a couple open gaps. We had this one really rare. We had an open gap here back in the March February time frame, and we hit an open gap once again here twice. That's a twice open gap. That is very rare. Usually open gaps always get filled. We have three on this chart. We have one right here, which is right below the S&P 500. We do have a line of support here, which it's been holding at. But keep in mind, it might be tempted to get down to this open gap and try to fill it. This is a two-time open gap here. And then below this open gap, we also have two lower gaps here, which is not a positive sign for the S&P 500 or the C-Fund long-term charts moving forward. Another thing we like to look at is trend line. I'm sorry, not trend lines, but lines of support and trend lines. So Ciovacco drew in this very interesting trend line here ever since May, and it's been holding here, which has been great. Found some great support in here, but keep in mind, if it fails through this, our line of support are quite significantly lower on this chart. So we want to be very cautious with that. We'd like to see it rebound off this line moving forward. Let's look at some of our defensive assets, or the F fund versus the C fund, or basically AGG versus stocks. If we were to put them on a chart of what is more desirable to own, or bonds, AGG versus the C fund, or F fund versus the C fund here, as you can see, it has not been better to own bonds ever since the March versus stocks. You'd want to be in stocks versus bonds throughout this time frame. One thing really interesting, though, we did break a trend line here where it'd be more favorable to own bonds or the F fund versus stocks back here in the beginning of September. We also broke a second trend line here after this breakout right here of it being more favorable to own the F fund versus the C fund or bonds, AGG over IVV ETF. Very interesting. We'll have to see if this holds moving forward. but that's just something to be cautious about as we go into the future. Another defensive asset that we cannot own in our portfolio, but it's something good to look at, long-term charts going all the way back into the 90s, S&P 500 versus gold. So in the 90s, it would have been much better to own gold versus the S&P, or to own the S&P 500 versus gold here. This was favorable versus gold, and then in the early 2000s, it would have been much better to own gold versus the S&P 500. Now, moving on to 2010 and beyond, something very interesting has happened in the last couple of years. 2018, 19, 2020, as you can see, the S&P has made a lower high and a lower low for the last 3-4 years in being favorable with gold. That is very interesting, as gold is a defensive asset. We want to keep that in mind moving forward. Next chart, I'm going to just blow that up of what I had here. I'm going to blow this chart up just a little bit. As you can see, in the last couple of years, higher high, or high, low, higher, low, or lower high, lower low, lower high, lower low, and this trend line has not been able, the S&P 500 has not been able to break that. 3 times now. 1, 2, 3, thrice. This third time, it might not even come back to break that. So it might be good to own defensive assets. What does that look like for us TSP investors? That means the S fund, the F fund, the G fund versus the C and S fund. For you guys out there in the Roth IRA world, you're looking at more assets in cash or defensive assets like the bonds, AGG, or something like gold. So just keep that in mind. We really like to see this come back, but that is not good that it turned down in September, and it has not really come back to find support ever since 2020, beginning of the year. Stocks versus bonds. All right, another chart here for you guys. This is more of a positive look on bonds. So just because things are going down, stocks do go down, does not break certain trend lines, doesn't mean it can come back. I mean, this is back in 2008. We saw that trend line going downward, and it did come back, but it took a long time from 2008 all the way to like 2017 to break this. 2011, we saw another little downturn here. 2012, 2013, little downturn here. Takes a while to break these downturns, so it just might be better to allocate a little more of your portfolio to the defensive assets for the long-term basis. 2016, a lot of downturns here. 2 failed breakouts before we saw something really break out in 2017. And now, 2018-19, also seeing a decrease. This hasn't even made it back to the trend line yet. So very interesting to see if it can do that or if it cannot moving forward. Last chart, it's not all negative, guys. I want to keep that in mind going forward. We like to look at trend lines and moving averages. I'm sorry, this is more moving averages with our charts. Here you can see price for the S&P 500 or the C fund. Here are our moving averages. Smallest on the bottom here. Our lowest moving moving average here. Sorry about that, tongue-tied. And our fastest moving average on top. So this is like going to be your 200-day moving average, where this is your 50-day moving average. Now this is what you want to see for a bullish market. Looks like a guitar string almost. Fastest moving average on top, longest moving average on the bottom, or yes, on the bottom. Now when price crosses through that, that's a definite concern, and it can get caught up in here, as you can see here. So that's what happened in March. We blew through these moving averages, moved way below them here. Charts really turned into a bearish manner here. It was not good right around the April-May time frame. Very, very concerning. Since then, the price, which is right here, came back through these. Within 2 months, it was able to get back on top of these moving averages. And now the moving averages are starting to look more bullish like they looked in early 2020. And it has not violated any of these trend lines as of yet. So that is a positive thing for the S&P moving forward, but we really need to see what this is going to do in the upcoming months and year to see if we violate any of these or if we can stay on top of this trend line moving forward. Again, we look at a lot of these studies to help us assess the probabilities of good things happening relative to the probability of bad things happening, which is significantly different from predicting or forecasting. We're not predicting what will happen in the future. We like to look at things in the past and assess where things are going so we can assess our risk moving forward. All right, all that said and done, guys, let's move into charts. The first chart we're going to look at in our charts in our technical analysis. First chart we're going to look at is the C fund, or IVV. Where are we sitting? Where are we looking? Well, like I mentioned, guys, we did get down to that 50-day moving average. We'll have to see if that holds. If it violates that, the next step down would be the 200-day moving average. Keep in mind, we have a long-term gap in here with this fund. We want to be very careful with that moving forward with IVV. But I think this chart overall looks a lot better than our next chart coming up. IVV, long-term basis, technical analysis. Let's take a look. Let's dig in. So the first thing you got to know, if you're a new listener, we like to look at price up here. This is price and what it's doing. Green bar is up, red bar is down. Okay, down here we like to look at two indicators to see if price is going to go up or if it's going to go down in the future. The first indicator we like to look at is the derivative oscillator. That's these green and red bars. When the green bars are rising, price tends to increase. When the green bars are falling or going into red, price tends to decrease. When red is coming back into green, price tends to increase. Goes back down, price tends to decrease. The other indicator we like to look at is the PPO line, price percentage oscillator line. What that is the blue line and the moving average, which is the red line. When the blue line, PPO, is above the red line, price tends to increase. When it goes below the red line, price tends to decrease. Two indicators that kind of give us a better, clear picture of what price might be doing in the future. And we go off the market, which is all market participants. So we like to look at these things, these two items, to try and base our judgments off of them to see where price might go in the future or assess our risk and probability percentage. All right, that all being out of the way, let's take a look at, we like to look at long charts and short charts. So long-term charts for IVV or the C fund. Where do we look, guys? Not good. Derivative oscillator is starting to move down. As you can see, last week we're at 4.6. This week we're at 3.1. Really not good on a long-term basis for this chart. So our first big red bar in here for price. PPO line is starting to get closer to the moving average. That is not a positive sign in the right direction for IVV. On our short-term charts, PPO line is way below our moving average. Not a positive sign. We are in red bars, coming out ever so slowly, but we need to be careful for a negative fake out on our derivative oscillator. That's where we see something like this, where it barely gets to green and goes right back to red. We want to see this get back into the green area so we can buy and make more profit for IVV. This fund overall is just not something I would buy at the moment. We are down quite significantly. We do want to get back in markets, but we're just not there yet with the open gaps we've seen on some of our charts. We're going to be watching this very closely, waiting for a crossover for our PPO line to get more involved and invest in IVV. Moving on to VXF or the S fund. Small caps. Where do we look? Where do we sit? All right, with small caps, we did violate that 50-day moving average. Not good, guys. We do not want to be below this. The longer we are below a moving average, the more significant it becomes. We needed to get above the moving average to ensure that we can get invested back into this fund. We are not confident in this fund right now, and moving forward, we'll have to see where it goes. That's basically this. The next fall, there is no trend line in here, would be down to the 200-day moving average, which is looking very flat at the moment. Where do we sit on charts? I've already explained the two indicators we look at. Let's look at long-term charts for VXF or small caps. Look at this, guys. Big decrease, 3.7 on the derivative oscillator from last week to this week, which was 2.0. Big decrease here for our signs, not positive. The PPO line is getting very close to our moving average. We haven't seen this cross since, you got it, right back here in March timeframe where we had a significant loss in capital. Please keep that in mind moving forward for long-term charts. On short-term charts, short-term basis, also two negative signs here. PPO line crossed right in the beginning of September here. The PPO, or the blue line, crossed the red line, saw a significant loss in capital, about 4%, and we have not been able to recover that. Derivative oscillator is coming back out here, but we want to be careful of the fake out if there is one. Want to see PPO to come back just to be a little more involved in this fund before we decide to jump in with some capital. Not good things from VXF here, really. Not really impressed with that. Let's move on to international markets. EFA or the I fund. This was one of the best performing funds for the week, primarily due to Friday. We had a 1% increase on Friday, but as you can see, this chart is consolidating. It is waiting for something. A lot of consolidation here. It is above the moving averages where it's consolidating. I don't like the 200-day moving average is pointed down just a tad bit here. I need to see it get above this consolidation to be confident to buy this fund. That's kind of what we're waiting on for that. For a technical analysis for EFA, where do we sit? Long-term charts. Long-term charts. Look at this, guys. We saw a rise back here in August, but now from last week we were at 2.5 on the derivative oscillator down to 2.1. Not a good sign here. A lot of indecision with market participants in here. Not a good sign as well. So with price, we're not really sure where that can go. I don't have a clear picture, and when I don't have a clear picture where I'm not confident, I'm not willing to invest. Our PPO line is above that moving average. It is getting a little bit closer. We just want to hold still until we get a better clear sign from this on a long-term chart. Let's go ahead and look at the 4-hour chart for EFA. EFA 4-hour chart looks a lot better than our other equity funds. PPO line just crossed here, so that is positive. We are positive on the derivative oscillator. Could have a good week moving forward. We do have 2 moves in our stock funds for TSP, so that might be a good time to get involved sometime this week here, but we'll have to wait and see on that. Looking for just this to really pop a little bit more, a little more. I don't want to see this indecision on this chart before we would get involved. Look at this, how much consolidation we've seen for pretty much all of August and September. Could see a pop out of this chart in the future, but we have a little bit more clear sign and guidance on that. Last of all, we're going to look at AGG, guys. Where do we sit for bonds? The F fund. Well, we had that double top here from March to August time frame, and this chart is also consolidating. Might I mention below the 50-day moving average? That is significant. Been below that for some time now. Where could that drop next? Well, it could go all the way down to the 200-day moving average. Not that excited for that. Based on our long-term charts that I showed you guys from CiovaccoCapital, we got to see something break out, either stocks or bonds. We're kind of at a indecision point right now. Need maybe another week or another month or so to get a clear signal of where things are going. Volatility is dropping a little bit, so that will help to see and get a more clear picture of where we're going. On a technical analysis for AGG, long-term charts, where do we sit? Ooh, derivative oscillator is in the negative here, guys. Not good. PPO is also in the negative. I'm seeing a couple down weeks in price. Not a good thing. The Bollinger Bands are getting kind of tight. When they get tight, we tend to see markets jump. I do not want to see this jump in the negative and be in the wrong position with AGG. So just holding out a little bit longer for bonds to give us a clear picture. Hopefully this can turn itself around for long-term charts. Short-term charts, we are seeing a positive. This is a good sign here. Might be a safe bet to jump into AGG this week or EFA, depending on which chart outperforms itself this next week. That could be our decision maker. PPO line just crossed the moving average. That blue line just crossed the red line. Positive sign there. The last time we saw that was in the beginning of August. Sorry, beginning of September. Saw a good little pipe jump there for AGG. And our derivative oscillator is about to go positive for this week. So that might be a good jump for AGG moving forward, going into this next week. If we make those moves, we'll make them on our Facebook and Twitter page, so you guys can follow us there. That is just about everything for the week, guys. Please keep in mind that we are up 8.4% for the year on the Top Notch channel. We are outperforming every single TSP fund for the year. We are outperforming markets, doing very well. We want to be very cautious moving forward for the last 3 months of 2020 as volatility is up and we have a presidential election. Do not want to lose our hard working gains, but want to stay above these charts here. Finally, guys, let's look into our allocation for the week. Top Notch, where do we sit? Where are we at? As always, guys, we did move at the end of August into the G Fund or cash, okay? G Fund or cash. For you that are in those other funds or Roth IRA brokerage accounts, we are sitting in there waiting to see what bonds or stocks do. We need a clear picture before we can start moving into some of these other funds. Again, if you want to see our allocations, Facebook or Twitter page, that's another Top Notch video. You guys stay safe. We'll see you guys next time.